Good morning. Good morning.
Good morning.
Good morning.
We want to welcome you to another McIlwain group at Sampson Property Home Buying Seminar and Happy Hour. We're happy to have you here. Happy October, happy Saturday, happy day. We have on here our great team members and our wonderful lender, Erin Johnson from the Johnson team at First Home Mortgage. Welcome, Erin. Welcome, Janelle. Welcome, Don. And T is on the line on her way to open house, I believe. So thank you, everybody. Welcome, welcome, and welcome.
Hi.
Hi.
Good morning.
Good morning. Good to see everyone.
So I always like to start off with our team leader, Janelle. Good morning. Let them know what's going on with us today.
Well, today we have an awesome lender on, but that's Erin, and she's going to break down some of the mortgage programs that may help assist with home buyers. As we know, the interest rates have gone up, but it is still a great time to purchase a home. You know, sometimes people think because interest rates have gone up that maybe they should consider renting, but guess what? Rent has gone up too. So everything's expensive, however you look at it. So what we're going to do is to break it down so that you can make an informed decision. And that's what we're here to help you do.
So Erin, talking about informed decisions, I mean, what's really going on in the markets? Interest rates are up. Explain a little bit, what's going on?
So first I'm going to say that yes, interest rates are higher than they were. However, they are normal.
Okay.
This is not abnormal. I actually, as an exercise for myself, went back to my pipeline when we were doing home loans in 05 and 06. And those of you who were around for that know that was the boom of the housing market. It was kind of the wild, wild west. The difference, or I'll talk about similarities. When I looked at my pipeline and looked at the interest rates that we were locking at that time, they were high sixes, low sevens. Okay, so this is equal to the interest rates we have now are equal to the housing boom that we had in 05 and 06. No different. So what happened in between them, between them was pretty bad. 08, 09, we know we went into a recession. It was caused by the mortgages that were out there. Sorry about that. Mortgages that were out there that were being basically, that was the wild, wild west too. You had a pulse, you got a loan. You didn't have to document a lot of stuff. You could have really low credit scores and get a loan. They cost a little bit more, but the rates were the same. The major difference between the two markets is there were a lot more homes on the market at that time, and there were a lot of buyers in the market at that time. So it created this big boom in the real estate market. The difference now is that we're coming off a very tight or restricted inventory. So when rates were nice and low, everybody wanted to buy, but nobody wanted to sell. There weren't houses on the market. We were in the middle of or coming out of the pandemic, and people were staying at home, or they had done work on their house during the pandemic and they were happy where they were. What we're seeing now are houses are going on the market. They may be sitting a little bit longer. We were on the market during the pandemic a week, it was gone. Now we're seeing houses sit on the market for 1 or 2 months. Part of that is the fact that not only have we recovered in interest rates, or we're higher in interest rates and equal to the 05 and 06, we have finally recovered value-wise. Because the other thing I found looking back at that pipeline from 05 and 06 is that the prices in our area were similar to what we're seeing now for the same type of homes. Okay, so realistically, we've gone through a recovery. Now, if I could address the elephant in the room with regards to comments on everything kind of slowing down and the fact that we don't have as many buyers out there because people are truly nervous about these interest rates. If we were to go into a recession, which there are indicators that we are heading in that direction, if we were to go into a recession, the thought process, or what has happened over the last 60 years, is that interest rates should drop down or level out and it won't be as volatile, and that home prices will continue to appreciate at more of a normal rate. Normal being 2 to 5% per year. We were not normal over the last 2 years where people were earning 18 to 20% on their homes that they'd owned for a couple of years. Okay, so we're now getting back into a more normal market. It's not to be scary. Now, Janelle, you had mentioned, is it a good time to buy? It absolutely is. And here's why you don't wait. Number one, yes, interest rates are a little bit higher, but we're going to qualify you with those interest rates. So you'll get into a house that you can afford. Number two, if the interest rates do drop down, you're only dating this interest rate right now, and you're marrying the house that you truly like. Okay, if we were to go back also, and there was a little study done that people that bought homes during the pandemic and during that craziness where you got in there and you bought this house and you paid more than you wanted, you waived all your inspections and you didn't do appraisals, all of that stuff, if you asked them if they were 100% satisfied with their purchase, they would tell you no. And it's the same concept. If you watch Shark Week, you drop blood in the water, sharks are everywhere. Okay. And people got into that frenzy where they settled because they could get it. Okay. So the other thing that I would anticipate that we'll start to see over the next couple of years is people might actually put their houses in the market because they're not happy with them and realize that they can handle the payment that they're handling now, so they could go up in payment a little bit. We may see some of those houses come back on the market once they get past the point where they're going to have to pay capital gains.
So you're saying there's some bad home marriages out there right now, possibly?
Right. They're just, they were dating the home. Bad idea.
Yeah,
Okay. And when you're a first-time home buyer, ideally you want to stay in a house for 2 to 5 years. Okay. 2 years because you avoid capital gains. 5 years because realistically that's where you're going to get the maximum boom out of your buck. But also, if you were to tally a homeowner, their first homes, they were in 2 to 5 years. Most of them, that's what they're doing. They're in different phases of their life by year 5. So when we talk about what's happening with interest rates right now, and I think it's very, very important because the news only says the Fed has raised the rates. Okay. I've said it. I sent it out on a newsletter. The Fed is raising the rate at which banks borrow money from other banks on an overnight basis. This does not impact 30-year fixed rates initially. This impacts credit cards, car loans, short-term rates a lot quicker than it'll influence the 30-year. Our 30-year fixed rates are being impacted by inflation. Okay. Inflation drives interest rates up because investors that are purchasing these mortgage-backed securities are expecting more money on their returns. The price for mortgage-backed securities or the demand for those are going down, which causes interest rates to go up. Okay, so inflation is what is impacting. As the Fed continues to raise the interest rate to try and combat inflation, it is natural, if inflation is still going up, that we will see interest rates rise. Okay, so, and the reason the markets react that way is because right now, with the Fed doing all their talking, and they all talk in between meetings, and there's always mixed signals really between the Fed presidents, those sentiments are relayed into the market. And the markets are assuming that the Fed does not have inflation under control just yet. Okay, so that is what's impacting interest rate, not the Fed movement, it's inflation. Now, Fannie Mae came out with an article the other day. I thought it was very interesting. They said by this time next year, we may be at 4.5%. Okay. Whether or not that's true has a lot of different factors to come to fruition. One, inflation needs to get under control. Everything needs to stabilize. It's very volatile out there. So I wouldn't count on it. And I wouldn't plan your next year of homeownership over it. Plan it on the fact that if you don't buy now, you're going to miss out on what is anticipated to be about 4% appreciation in the market over the next year in our area. That's what's anticipated. Where can you earn 4% in your money right now?
Nowhere.
Correct. Nowhere. 4% is an awesome rate of return, even if you're paying a slightly higher rate of interest. And 4% year over year your return is greater than anything you're going to find out there as far as investments, other investments. Okay. So I believe, at least right now, even though it's a little different, that we're still in a very good time to buy a house. So state of the housing market, we are seeing houses sit on the market a little bit longer. You guys can correct me if I'm wrong, but I'm seeing closing help.
Yes.
We're seeing closing help out there. Okay, so what that means is that sellers are still selling their house for pretty much the price. They have come to the conclusion that in order to get their house sold, they're going to have to give a little. And they're being counseled that way by really responsible realtors to prepare them for the worst case scenario. If they happen to get multiple offers and can take their pick and net a little bit more by not paying closing help, that's great for them. But I am seeing a large percentage of contracts coming in and there's closing help being paid, sometimes up to 6%. Not the norm. Okay.
That is definitely not the norm.
Right. I know. And there are still some fights, and there's still some dog fights out there in the lower price ranges. If you're looking at a $250,000 house, you're going to see that there's more than one person making an offer on that house because they get on the market and they are still going. But when you go up into the higher price ranges, the 350 and up, those houses are there a little bit longer. It might take a little bit more effort to sell. We're seeing more open houses. We're seeing brokers opens. We're getting to the point where we're going to see a little bit more normal as far as the traffic and the how quickly the houses are selling. When we get to 6 months, it's a buyer's market. We're only at about 2 to 3 months right now. But I'd like an even market. That would be a win. So what else can I tell you today? I know that you guys had some questions about programs.
One thing I want to get back on is when you were talking about the market, because what we found was that prior to this, buyers really got caught up in the craziness.
Yeah.
They would have to over bid on a house. They would have to put extra money on the house if it didn't appraise. And so the great thing about now is that the buyers are now getting a more fair advantage over where they were. And so one thing that we always have to instruct our sellers is that they have to understand that this is not the market that we used to be in.
Yes.
Buyers are now having the ability to go out and look at more homes, not rush into purchasing more homes. And so we need to, as agents, not get into that rush that we were in like last time. So we have to educate not only our buyers, but we have to educate our sellers. And I think it's just great that now that our buyers can actually make informed decisions about homes instead of purchasing homes without home inspections and appraisal and all this other stuff. And so now it really is advantageous for them to take advantage of it. But just like you say, interest rates, they're going to come back down. It may not be now, but they're going to come back down eventually. And so now you have the ability to, like you say, people jumped into houses that they really, they liked it, but they really didn't like it. But, I got to hear them get a home because of the interest rate. And so now we have a lot of people who are, they're like, well, I guess I wish I waited. Now the buyers that are out here, they're more educated and they're not into that big, stuff, trying to figure out what. And then the great thing about it is that, as I tell our sellers, they're more educated. A lot of these are stronger buyers. They're more educated about it. And they do understand that the interest rates weren't normal before.
Yes.
So now we're coming into the normality of what interest rates are. And so I just think it's a great time for our buyers. They make informed decisions. They don't get caught up in a rat race. And then they don't call us another year or a year and a half later talking about, you know what, I can't stand this house. You need to get me out of it.
And as a buyer, I would shift my focus away from interest rates and focus payment. This is how much I can afford. Okay, we have conversations with our clients all the time. And what I may be able to qualify them for might be quite different than what they want to pay monthly. So it's a very personal thing that you have, a conversation you have with your lender. You say, this is how much I want to spend. We will show you what your maximum ability is, and we'll come to some comfort level for you to get you maybe into the house that you really love and you really want, without jeopardizing really your affordability. We talk about budgets. We look at, here's the difference. If you spend $10,000 more on a house that is your ideal payment, that payment only goes up $58 per month. It's not that much a difference to get exactly what you want versus something you will settle for.
That's very true, because even when the market was crazy, people were getting qualified for these outrageous numbers and they were still bringing them down.
Yes.
So that is a great idea, so they can focus more so on payment as opposed to interest rate.
Yep.
Because they were doing that anyway, just not realizing they were doing it.
Right. It's always been our focus, because when we qualify you, we look at what your payment is divided by your gross monthly income. That's your housing expense ratio. And we don't want to see you exceed a specific amount of that ratio, even though when we get it into process, all of the agencies, Fannie, Freddie, VA, HUD, they all look at your debt to income ratio, total debt. We as lenders, I'm focusing more so on your housing expense. I don't want to see 50% of your gross monthly income going to your housing expense. That's a lot of money. That leaves no room on the back end for any other debt. Okay. But we can fit within this, and you should be comfortable with that payment. So I know you want to go into programs now, because we can talk about the Smart Buy specifically, since that was the question that we asked. And I know, Dawn, you asked me what that interest rate was, and the Smart Buy interest rates right now, they have a 7%, a 7.125, and a 7 and a 7.125. So there are 3 different programs in the Smart Buy program currently, and this was an enhancement to what we had before. They did go to a 3% down program as opposed to a 5% program. It is a conventional loan. That means you've got to have greater than a 720 score to qualify. Okay. The Smart Buy program is a win for people who have student loans. The Smart Buy program will allow you to pay off up to $50,000 worth of student loan debt that was used for your education. And it has to be your education. Can't be me buying it for my daughter's education. I wish. So that Smart Buy will pay off, and it's in the form of a second mortgage, which is no interest, that is forgiven after 5 years.
Wow.
Okay. Now there are 3 tiers to that. One is a $6,000 down payment assistance tier. One is a 4% down payment assistance tier, and there is a 6% down payment assistance tier.
Wow.
Yes. So the 6,000 and the 6% down payment assistance are both 7% right now. And you'd think that 4% would be less on the interest rate, but it's not. And the reason for that is, on the 6% down payment assistance program, you have to be at 50% or less of the area median income limit. That will take some buyers out because they'll be over the income limit for that program.
So they need to be under 50% of the median.
Of the median income, yes. And they'll give the 6%, and it's a 7% rate. They'll pay off the student loan debt. So basically they could get in with 0.
Typically,
I'm sorry.
no, I was gonna say, typically if someone has a 50, because I've never had a student loan. If someone has a $50,000 student loan debt, what are they paying monthly typically?
Well, it varies.
Okay.
So first and foremost, they can do an income-based repayment plan, where it is based on the income of their income, and they say you can afford this much in a payment. They can do a fixed payment plan, which usually has a higher interest rate, and it's over a 20 or 30 year term, almost like a mortgage. Or they can do, they could put it in forbearance or deferment. So a lot of us who had student loans have, over the pandemic, they were put into forbearance. That's been extended. So they're reflecting a 0 balance on their credit report, and they're not going into repayment. Now, the rules for the agencies are very clear. They know at some point a repayment would occur. Because we look at the ability to repay that mortgage now and in the future, we are counting payments even if there's a zero payment on there. For a conventional loan, we either have to count 1% or 0.5% of whatever the balance is. So for $50,000 in debt, that's a $500 monthly payment that we're counting against them, or a $250,000. Am I doing that right? Doing that in my head, guys. Hold on a second. It's a Saturday morning. So we're counting a payment. It's either 0.5% or it is a full percentage, depending on the program that is being used. So $50,000 times 0.5%, $250 or $500, one or the other. Okay, so it's another debt, and it can impact qualification. Not everybody will qualify, and there is one caveat to that program. If you have $60,000 in student loan debt, we'll pay off the 50, and you have to pay off of the 10. You cannot have any student loan debt once this is all done.
Well, the great thing is that 7% is right in line with the current interest rates, because typically the programs are way higher.
Right.
At least that's been the trend over the last couple of years.
Yep. Well, the Maryland mortgage program in general, because it's geared towards first-time homebuyers, and there is a program that they offer that doesn't require that you're a first-time home buyer, but we focus mostly on that first-time home buyer program. Because it's geared towards that, they're looking for advantages. It's priced differently than the normal interest rates are. So it's basing it off of bonds state bonds, as opposed to mortgage-backed securities that are traded that way. So they have a different pricing model, and they typically come in slightly lower or at least even with the market. Anytime you take money from an entity like a state bond program, a Chenoa, anything like that, you're going to find that you're going to pay a slightly higher interest rate than you would if you were not taking money, because the Maryland mortgage program also offers a First Advantage program with no down payment assistance, which is about 0.1% below market right now with no points.
Okay.
So Erin, I know you mentioned different tiers in which they could, I guess, qualify for. Is there, I might already know the answer to this, but are they able to qualify for more than one tier?
You cannot stack the programs.
Gotcha. Okay.
Okay. Yeah. The Maryland mortgage program, it's one program or the other. You can't do both.
Gotcha. Okay. So can that program be used with any other type of financing? I hope you understand.
Only conventional financing.
Only conventional. Okay, very good. Okay.
So if we're looking at someone in DC,
okay,
and they're using HPAP, which just increased to 242,000, which is awesome.
Yes.
Could they do both? I know they're not stackable, but that's a different.
You can only do Maryland mortgage program in Maryland.
Well, so that would be a part of the Maryland mortgage program. So there's not that option in DC.
Correct.
Okay. Alrighty.
Okay.
I'm getting ready to call. Oh my goodness, why am I having a brain freeze? I'm going to call Dawn Erin. So actually, the question is for Dawn. Can you explain that program in DC that you just spoke of, and how that?
So there are some income restrictions on it, but it used to be 80,000. Then you'd have an additional 4,000 for DC open doors for DC employees. So starting October 1st, they raised that amount for the HPAP program to 242,000, which is great in DC because there is an income cap. Also, people in that income range may only qualify for 300,000, and you're not getting anything in DC for 300,000.
Yep.
You're not getting a condo for 300,000. So now you can qualify for up to 242,000. So now that 300,000 approval is 542,000. The thing is that it is a tedious process.
Yes.
So you have the class to go to, you have counseling, you get a certificate, it lasts for about a year. Now it does get tricky. We're getting into a market where, and the thing is in DC, everybody does it. So it's not like, it does hinder you a little bit. Of course, if you have a straight conventional loan, the listing agent's going to prefer that. But in DC, the HPAC program has given you so much money so long, everybody's doing it. So at some point, you're going to accept an HPAC program.
Yeah.
And then you also have like the DC firefighters, the police, they get 50% off in certain areas. So there are great programs in DC.
Yes, the HPAP with DC, the first thing is always to go and take your home buyer class through their counseling, and then we do that loan here. And the not everybody will qualify for the maximum, but it's based on it's tiered for your income, and it's tiered. So some employers offer DC, and employees, of course, get additional stuff. Now with you mentioned the 50% off. That is the Good Neighbor Next Door program.
Mm-hmm.
And that is, they have specific homes that you will actually apply for. And then you go to your lender, and we just basically do a loan for 50%. And there's a set aside of the other 50% that as long as you occupy for a certain term, then you don't have to pay it back.
So I misquoted the amount. Is $202,000. And for a family of 4, your household has to be less than $71,000.
Yeah.
So the threshold is low, but it's allowing the people in that price range to be able to purchase. Because at this point,
there's nothing
qualifying at having a 71,000 income, you're really not qualifying for anything.
Yeah.
So, but like I said, it is a tedious process.
Yeah. It can be.
Yeah.
Now that I'm sorry, go ahead.
No, most of these programs, be prepared that you are going to feel like we have papered you to death. We're going to ask you, and there's a lot of time restrictions in some of these programs too, as far as, what we have to do, what the whoever's doing the program has to do, and how much time has to be allotted in the contract, and how the property has to be has to look, or things like that. I don't know. I cannot remember. Does HPAP have a requirement on the property condition? Because when we did the PG County programs, they have an inspection that has to be done to ensure that house passes a certain.
HPAC also has their own inspection for that. Yeah.
Yep.
They also have an inspection.
Not a bad thing. If you're giving that much money, you want to make sure they're getting into a home that is livable and in good condition, and, passes all those inspections.
Now, for someone of one household income, or say a 2 household income, or one household is 109,000 income.
Yeah.
So, and you can get 70,000 for that. So it's a great program.
It's a great down payment.
It's a great program.
Yeah.
I do want to ask, I think I really do love homebuyer assistance programs for home buyers. But what I do want to talk about just a little bit, because sometimes what happens is, especially our first time home buyers, sometimes what happens is the first time home buyer, they hear about a home buyer program and they automatically want to jump into the home buyer program. But there are some pros and cons of just actually doing a home loan in comparison to doing a home buyer program loan also. And so I think that I'd like to talk just a little bit about that, because I think they really need to understand not only their options, but maybe a little bit of the difference in them.
So I can speak very clearly, because this has come across our desk recently on the Maryland Mortgage Program. These programs are for first-time homebuyers, or for homebuyers that are purchasing a primary residence. Recently, we had a case where someone bought a home using the Maryland Mortgage Program and lived in the home for 2 years and then wanted to rent the house out. The rule says it cannot be used as an investment property. As soon as they changed the mailing address on the mortgage statement, the master servicer for the Maryland Mortgage Program called the loan due in full.
Can you repeat that? Because can you
Wow.
repeat that? I think that that's something that we need to repeat.
I think that's extremely important. If you
That's
are
major.
purchasing a home using the Maryland Mortgage Program and you are going to convert it into a investment property, you need to either refinance and get that loan into a different program and pay off any money that you paid. Because if you change the address on your mortgage statement, as this person did, and as that would be normal, they will call the loan due in full. And now this was not something that was made extremely clear in the documentation. We went back and forth with it, but it is something that we have been told now to tell all of our clients. If you intend at some point to use these properties as a rental property, do not use that program.
So question, so the, after 5 years, the second is forgiven.
No, on the Maryland Mortgage Program, any second mortgage you take out is due in full at the repayment of the first mortgage. So if you have this loan for 30 years, you still have that second mortgage to pay back.
Okay.
Okay. If you refinance, you have to pay it back. If you sell it, you have to pay it back.
Okay.
Okay. So that's something when planning your future steps that you need to make very clear with us. Now, it still would not stop me from using that program if I was a first-time homebuyer and needed the assistance. Absolutely not. But make sure that you're very clear on your plans for that property in the future. If your plan is to convert it to a rental property, let's see what other options you have. Okay. Or let's make sure that we refinance you out of that loan at least 12 months prior to turning it into an investment property. And I say at least 12 months before doing that, because if I refinance you as a primary residence, I can't turn around later and buy another, 30 days later and buy another primary residence. It doesn't work that way. You sign an agreement when you go to the table that you're going to occupy the residence as a primary residence for at least 12 months from that date. Okay.
Good to know.
That's important. That's very important.
So coming out of the market that we're in with the interest rates increasing and with Fannie Mae and Freddie Mac applying loan level pricing adjustments to their pricing specifically for second homes and for investment properties, we've had a high amount of occupancy fraud. It's a big deal. If you are going to buy a house to live in, that's great. If you are thinking you're going to work around the cost to purchase an investment property or a second home by saying you're going to live there, but not, be prepared that that is fraud.
Now, Erin, that leads me to a question I was going to ask you, because you said everyone doesn't know what they're going to be doing in 5, 10 years or whatever. And because this is their major purchase for them right now.
Right.
So let's say we're 3, 4 years into this program and my spouse and I, or myself, whatever, we've decided, no, we're ready to make our next move into our bigger financial future. Is there a way that we could mitigate some of these, or
talk to your lender?
Okay.
Talk to your lender and let us help you plan that.
Honesty is the best policy, is what you're saying.
Absolutely. Absolutely. Let's make sure that you're set and ready. And if you think if you think you want to start building an investment portfolio from your first home, and I will say, I always feel your first home is your investment.
Right, correct.
And if your plan is to invest in real estate, which I think is a great investment for everybody, if you're going to do that, let's come up with a plan, and let's do it before we're hustling to try and figure out ways around things, or just refinance it as an investment property and buy your next home. But we need to make sure that we've done all of our due diligence and that you're not going to get left holding a big bill at the end.
I've always been told that you don't want to lie to two important people, your doctor, right? And
right.
Your accountant, but we should add lender to that? Is that?
Yeah, don't lie to your lender. That's really not a good thing. Well, and keep in mind remember, I referenced it when we talked about the market. Let's go back to 08 and 09. The reason reason we have the rules we have today is because in 05 and 06, it was the wild, wild west of lending. You had a pulse, you got a loan, thumbs up, okay? And anything went. When they went back and looked at why the mortgage market failed, not only were there bad mortgages, there was a lot of fraud in our industry. And unfortunately, it wasn't caught, it was undetected. So when we take a loan into process now, there's so many checks that go through. There's so many things that we're looking at in the background that you guys probably don't even feel or know, because most people are honest. Okay, well, you got that one and it spoils the whole basket.
This information is good for us as realtors as well, as we start to talk about these programs, and the information that you just shared is invaluable because we can ask those upfront questions when we're, kind of learning about what our buyers' needs are in regards to a property, what they plan to do with it. And then, also understand, once those needs, I always say, once those needs are met, then those desires start to kick in. So I think that what you just shared is huge, because I don't think that home buyers or potential home buyers will be aware that you need to be very clear about how you're using that property and what your intent is.
Absolutely.
And I find it really, and I'm sorry, and I just want to say one other thing, and it's so funny because you're right, it's occupancy fraud, and you really haven't really thought about it. I don't think I've thought about it like that until you said it. Mm-hmm. And now it makes me go back to think about, sometimes if you ever maybe go search your property and you'll see images or aerial pictures or pictures of your property, and you're trying to figure out, well, how did they get that picture of my home? So sometimes I think I'm wondering, like, if maybe the lenders are going out verifying occupancy in that way too. So that's something to keep in mind.
It could be. So they have the right to drive by and inspect. They can't go into the property, but they do. And how often that happens, I don't know. But, they are, keep in mind that when lenders do a loan, they have as much interest in that property as you do until you pay that loan off. They have to make sure it's marketable. They have to make sure their asset is protected because that loan is secured against that property. And that's really where it comes from. And they have to be very careful. So in other words, we have to have a relationship with our doctor, a relationship with our accountant, and our real estate team. It's extremely important to have a good relationship with your lender and your realtor. And we are your best sources for that information.
And I agree with Tia also about this information, because in a conversation with a potential buyer, and not even with them attempting to commit fraud, just in a normal conversation, they could say, okay, I'm buying my first home in 5 years, maybe I want to rent this house out, with no intention whatsoever. But at that point, there's the red flag that says, well, wait a minute, I know you're doing down payment assistance. Go ahead and give Aaron a call and let's see what another option is, because you renting that home in 5 years may cause a problem.
Right. Or make sure you have an escape plan.
Mm-hmm, mm-hmm.
Make sure that we've done everything that we need to do to protect you in this situation.
Because reality of it is, they may say they're renting in 5 years, that they're going to do it in 5 years, and they stay in the house for 17.
Right. Exactly. Yeah. I mean, you never know you never know where life takes you. Right. Mm-hmm. But it's definitely something that you have to it's just a conversation, and it's a plan. I think, failure to plan is a plan to fail. So always, always, always have these conversations, so that if it's in 5 years, you definitely want to do that. So let's start talking around year 2 or 3, and let's see where we are. And if it's possible to go ahead and get you out of that program so that you're prepared.
Right, because you're not going to need the money you needed to go into the house originally. You can refinance and have that all rolled into that.
Right. And in some cases, you may be using an FHA loan, and then 2 years from then, you can do a conventional loan, and that conventional loan can avoid mortgage insurance, which decreases your monthly payment, even if you don't save on the interest rate.
Right.
So if you figure in the $300,000 range, and on an average, mortgage insurance is between $200 and $250 per month on an FHA loan, refinancing to a conventional rent loan at the same rate saves you that $200 to $250 a month right off the bat. And it's an easy step.
Well, today we have covered a lot of great information. We've been into home buyer programs. We've talked about how to not be in home loan fraud. We've talked about loans that deal with student loans. And so what I want to do at this point, Erin, I thank you for helping us spread this great information.
Thank
And
you.
if you would give your contact information so people will be able to reach out to you. And as we always say that we're here as a team. Erin has been a great partner with us that has helped a lot of home buyers get into programs. And we do thank you for your partnership, Erin.
Thank
So
you.
Erin, if you would give your contact information.
Yep. Doing that now.
Oh, okay. Well, you can
Drop it
just
in the
say it.
chat box. It's
Well, you can just say it.
Oh, okay. I was adding it. Okay, so I'm Erin Johnson with First Home Mortgage. My email is ejohnson@firsthome.com, and you can reach me at 301-818-0648. And I really love doing these on Saturday mornings. So thank you for including me, and I hope to be involved in more.
As always, we thank you for coming and supporting us. We do these home buyer seminars every second Saturday of the month. We try to keep them down to 1 hour because we know people have things to do. We try to, get as much information as we can out to our people because we want to make sure that our home buyers and our home sellers are making some intelligent decisions when it comes to home buying. I'm Janelle McIlwain. I'm with the McIlwain Group of Sampson Properties. We have ESO. He's one of he's the backbone of all of this. He's the one that keeps us going. Tom Ferguson and Tia Thompson. Also, Vonnie, she couldn't be with us today, but she's a part of our team, and also Paulton Myers. So we do thank you again. We thank you for joining us. Stay tuned. We'll make sure that we get this posted on our YouTube channel. It will be also posted on our Facebook, and we'll see you next month, the second Saturday at 11 o'clock.
Thank you, guys.
Bye, guys.
Bye.
Bye.